First, I'm going to talk a little bit about this trade. So I'm sitting at my desk in 2007, the fall of 2007, and at the time it was downtown New York City. And I get a call, and at the time things were going really badly on Wall Street and beginning to go bad in the whole financial system. And left and right, firms were losing billions and billions, reporting billions, and everybody was sort of downbeat, and we're trying to figure out who's the next firm to report really poor earnings and troubles. And I get a call from one of the top hedge fund managers in the world, a famous guy, and he says, "Greg, I just played tennis with this guy, John Paulson, and the guy's making a fortune out there. You should look into it." Now, I'm a guy who, my whole career, I write about different things. I've written about the bond market and equities and hedge funds and private equity, all kinds of stuff in the Heard on the Street column. But my bread and butter, what I love doing, is I love writing about home runs and strikeouts. I'm sort of a sports guy. As a writer, there's a lot of drama and tension and people that do really poorly and mess up. And I illustrate why that happens, but also the guys that hit home runs and do really well, and the firms that make great trades, but also make great decisions. And I think there are a lot of lessons that can be learned from both. So I love home runs and strikeouts. And here's a guy telling me there's a guy making money while everybody else is losing money. So the more I look into it, I dig into it, and I realize this guy isn't just making money. This guy is making a fortune. He's making the greatest trade ever, this guy, John Paulson. And I ended up writing a front page story, and then in 2008, he did even better. So together, between 2007 and 2008, he made $20 billion. And it's by far the greatest trade ever. The only thing going into that, before that, the greatest trade had been George Soros betting against the British pound in 1992, and he made $1.5 billion. Pshaw, $1.5 billion, who cares, right? But this is a guy making $20 billion. So I'm a guy who likes home runs and strikeouts. Here is the greatest home run ever. So I get excited, and I start writing this book, and I subsequently published it. And the thing that drives the book, and the paradox, the conundrum, is why was it John Paulson that figures out that the financial collapse is coming and figures out a way to make money from it? And the book really is about a group of people who figured this out. And I'll tell you a little bit about each of the characters, and each one is, I would argue, is more unlikely than the next to have anticipated the financial meltdown and made money from it. So I'll tell you first about this guy, John Paulson. So he was born in Queens, borough of Queens in New York, and middle-class background, went to New York University, had to take some time off during college to find himself, traveled in South America, came back and did very well in school, and went out to Harvard Business School, made partner at Bear Stearns early on, then he set out to start his own hedge fund. And for years, he was, continuing the sports metaphors, I apologize for that, he was a singles hitter. And he was pretty well respected on Wall Street, but no one really knew him. He did merger arbitrage. Merger arbitrage is among the safest forms of investing. You buy a company being acquired, and you bet against the one doing the acquisition, and you get good returns, but nothing dramatic. And double digits is rare. And so he was a merger arb, a great guy, and about 2005 or so, he started getting worried about housing. He read what we all read at the time. He got concerned, like a lot of other people got concerned. He said, I got to protect my portfolio. I see something coming, I'm feeling some tremors out there, and he's worried about the big one. So he tries to buy some insurance on it, buys put contracts on the S&P 500, but they're too expensive, he views, and he just doesn't know what to do. So he basically throws himself into housing, and with a right-hand man, who I'm going to talk about in a second, they figure out that A, housing is overpriced, B, the best way to bet against it is to buy these contracts. They're called credit default swaps, or CDS. It sounds very complicated. It's not. It's basically insurance, and I met some people last night who sell insurance. It's not so dissimilar from buying insurance on a car or on a home. Instead of buying insurance on a car at home, what these guys did was that they bought insurance on toxic piles of mortgages. stuff that's called subprime mortgages that in their view was unlikely to be good. It was eventually going to fall in value. So they bought all this insurance and they ended up making billions. And what's dramatic to me, what's striking to me is that John Paulson didn't know much about housing. He had bought and sold a couple homes over the years, but he was no housing expert. And yet he anticipated the meltdown. Who should have, if you think about it, who should have anticipated the meltdown? Well, people like Warren Buffett, Bill Gross. Bill Gross is the bond king out in California. I went out to meet with him, and for my book, I kind of did research all over the country, and I asked kind of these people, George Soros, those kinds of people should have been the ones who anticipated the meltdown. And I kind of said, why didn't you do this trade? And people had these kind of explanations. Well, Greg, I knew housing was a problem, but I didn't know it was this much of a problem. I knew housing was going to collapse, Greg, but I didn't really know how to put on this trade. I didn't know anything about credit default swaps, CDS. And it comes back to me, the fact that John Paulson, it's impressive to me that John Paulson was approaching 50 years of age, and he threw himself into learning what these credit default swaps were. So it's not just the fact that he was bearish on housing. I'm sure a lot of people in this room were bearish about housing. John Paulson figured out how to express that view better than anybody else. So, but again, he's not a housing expert. He shouldn't have been the one. His right-hand man, let me tell you another guy who made a lot of money and did well from this downturn. His name is Paolo Pellegrini. Paolo is a native of Italy, and he also went to Harvard Business School, smart guy, but he spent his career sort of kicking around Wall Street. He was at Lazard Frères, which is an investment bank, and he at some point basically was told, he got the signals that he wasn't going anywhere and he should leave and find something else. So he kind of got pushed out there, and he spent a number of years looking for jobs and trying to trade and trying to figure out what he should be doing. And he found himself in 2005 in a one-bedroom apartment in Westchester, north of New York City, looking for a job. And he had been through 2 marriages already, and he had 2 children, and he didn't want to go back to Italy and leave them behind. So he called up John Paulson, and he said, and they had met each other, they had overlapped a little bit at Bear Stearns years earlier. And he said, John, I hear you're looking for someone. Someone had left recently. There was an opening at the firm, at the hedge fund called Paulson and Company. And he said, and again, if I'm going too fast, please kind of raise your hand up there. I can't help it. So he said, John, I could use a job. I see there's an opening. And Paulson said to Pellegrini, this isn't really a job you want, Paolo, because Paolo was approaching 50 also. And the opening was for an analyst kind of job. The person who had left just went to business school, and it was sort of a junior job. And Pellegrini said, no, I could use the job. I could use the opportunity. Give me a chance, John. So he came over and he interviewed, and he did really poorly. He came off as kind of arrogant. He was very insecure because he had been out of the markets for a couple of years, and he came in and with all these big ideas, and he tried to impress, but the people that he met in the interview thought he was kind of arrogant, and he can come off as a little bit arrogant too. But Paulson said, now let's give him a chance. So Paolo Pellegrini joined John Paulson's team, and for about a year or so, he came up with no good ideas. He was supposed to do international merger arbitrage, come up with good ideas, and international M&A, merger and acquisition deals, and he really didn't come up with too many ideas. He ended up coming into the office extra early so he can get a cheap parking spot because he thought this was his last job. And lo and behold, when he heard that his boss, John Paulson, was worried about housing, Pellegrini knew a little bit about these credit default swaps, and one of the jobs that he had been fired from, he came across credit default swaps and learned a little bit about them. And he basically said, hey, boss, if you're worried about housing, we should buy these credit default swaps. And together they threw themselves into learning what they were, and they brought in experts, and they educated themselves. And Pellegrini figured out how to put on this trade, and it's a complicated trade, and Pellegrini did it. And a year later, so in 2007, he had been remarried at that point. Talk about the greatest trade ever. She did pretty well for herself. So they're on vacation with his third wife, and they're in St. Bart's. And Pellegrini is a superstitious guy, and he didn't share too many details with his new wife about how the trade was going. And she knew it was going pretty well, but she didn't really have any details. So they stopped. She needed some cash. She stopped at the ATM, and they were going out for the day. And she looked at the screen of the ATM, and she said, "Paolo, there's $70 million in our account." And that was part of the $170 million that he got paid that year. So he goes from a one-bedroom apartment to $170 million in a couple of years, not the most likely guy to have anticipated the meltdown. There's another gentleman I write about in Northern California named Michael Burry. Michael Burry was a doctor who kind of got sick of being a doctor, started trading, started a hedge funds, and he, even a year before Paulson, in 2004, became convinced that housing was going to collapse. And he discovered these credit default swaps before anybody, right when they were starting to introduce them. And he started buying them up. And his own clients didn't believe in him. They said, it's one thing a doctor to start trading stocks, but now a doctor is going to start doing derivatives, going to be betting against housing. What do you know about this, Michael? So they started fleeing. They put pressure on him to not do this trade, not to bet against housing. And he battled with his clients back and forth. And he ended up making a lot of money on this. It could have been the greatest trade ever, but his own clients made him cut his positions in half. But he's an odd guy and a headstrong guy and a stubborn guy. He likes to turn off the lights and close his eyes and think about what could go wrong in this world. But he's not the most likely guy to have anticipated the meltdown. In Southern California is another gentleman I write about named Jeffrey Green. Jeffrey Green was a real estate investor. So he knew something about real estate. He had made a lot of money in the 90s in California, and then he lost it all because in the early 90s, Los Angeles had real problems. And then he built up his fortune again. And he was sitting on a lot of money in condos and all kinds of real estate holdings throughout the Los Angeles area. But he was scared to death because he had seen Los Angeles collapse once, and he didn't want to see it happen again. So he went to his friend John Paulson. They had chased women together years earlier when Paulson was single. Jeffrey Green was still single at that point. And, but they're both approaching 50. And Jeffrey Green went to visit Paulson in New York, and he said, John, I'm worried about housing. What should I do? And Paulson said, oh, if you're worried about housing, you should invest with me. I'm starting to bet against housing. And at the time, Paulson couldn't get much interest in his new fund, which was betting against housing. And Jeffrey Green came back from New York, and he said, yeah, I like the idea of what John's doing, but I don't want to give him my money, so I'm going to go do it myself. And he stole the idea, basically, and he figured out how to do it on his own. And he ended up making $1 billion from the housing collapse. And just to tell you how unlikely it was that Jeffrey Green made $1 billion and some of the smartest guys in our country didn't, Jeffrey Green did get married right afterwards, and the best man at his wedding was Mike Tyson. And for a while before that, he had a house guest at his home, Heidi Fleiss, the Hollywood madam. So, he figured it out. There's another guy I write about named Andrew Lade, who was a younger hedge fund guy who got fired from his firm, also kind of stubborn and headstrong. You see a little pattern there. And he found himself also in like this condo by the beach in 2006, convinced that housing was going to collapse. And he said, if I can only raise a little bit of money to bet against housing, I'm going to make my fortune. The only thing he was just as convinced of was that marijuana should be legalized. So those are my characters. And so the question comes back, I keep coming back to, is why did these guys figure it out? And why didn't the best and brightest of our nation, the Geithners and the Bernankes and Greenspan, you go on and on. The thing that I always find amazing is that the very people that should have known better were the bankers, right? The bankers are the ones who created this product, and they're the ones who lost the most. And it's almost like a butcher who's got this noxious, poisonous meat, and instead of carving it up and selling it to customers every day, the butcher brings it home and says, honey, I'm home, and gives it to the kids and starts munching on it, and they all get sick. And that's sort of what happened to this nation, where it was Bank of America and Merrill Lynch and Lehman Brothers and Citigroup. Those were the ones who got sick the most. If you think about the wealth that was destroyed, I mean, Jimmy Kane, the head of Bear Stearns, was a billionaire going into this thing. He's worth like 10, 20 million now, so he's not a poor man, but I don't subscribe to the view that Wall Street was out to get America. I think that Wall Street missed it as much, if not more, than anybody else. So I have some views as to why, and there's some lessons I think that we can learn in any kind of business. Part of the explanation, I would argue, is for why this happened is that on Wall Street, products evolve and become more complicated every year. And that's mostly so that they have new things to sell you guys, and they can charge more for them. So every year they're trying to come up with some new, more complicated products. So it started off with mortgage-backed securities, and that begat CDOs, collateralized debt obligations, and other things called synthetic CDOs, CDOs squared, and it got to the point where 2006 or so, the guys at the top of these firms, the Stan O'Neill at Merrill Lynch, Dick Fold at Lehman Brothers, they had no clue as to the risk portfolio of their own firms. It was just too complicated. They deferred to the guys, the risk specialists. So then you say to yourself, well, okay, what about those risk guys? What are those guys in the middle that it was their job to know how risky their portfolios were and their banks were? Well, as life has become more complicated for us all, we often defer and depend on models in our lives. I mean, British Petroleum had a model saying that there wouldn't be the very, very, very small likelihood of having a spill in the Gulf, and their model was wrong. Well, similarly, Wall Street became very dependent on these models, and the models basically were very reassuring about mortgages and about the housing market. And because the models were all built on historic data, and historically, our nation had never seen a national housing collapse. Sure, there were pockets here and there. There was weakness over time, once in a while, but never on a national basis. So the models were very reassuring. And all the specialists in the middle, they kind of said, well, our models are very reassuring. And the rating agencies all called this stuff AAA, said it was very safe stuff. And the rating agencies had their own models, also based on historic data. And they also got kind of caught up in this whole thing. One of the explanations for why guys like John Paulson and these other guys, Jeffrey Green and Andrew Lade, they saw this coming and they anticipated this meltdown, is they came from a very different world. They didn't come from the housing world. I would argue you almost need to come from as being an outsider. There were all these great explanations, and I talked to people all over why they didn't see this coming, and there were all these great explanations. Well, Greg, even at the time, they said, well, the housing market's never really going to collapse on a national basis. The Fed will cut interest rates. The government wouldn't let it happen. It's never happened before. And guys like John Paulson, who was approaching 50, and Jeffrey Green approaching 50, and then Pellegrini, they remembered that in the early 90s, there were some pockets of weakness, Boston and Texas and Los Angeles, as I mentioned. And they said, well, it's not that big a stretch to say there were pockets of areas with real deep weakness. Why can't the nation as a whole have a financial downturn and a housing downturn? So they said, you needed to be something of an outsider, I would argue, to have pulled off this trade. And they went around and they said, all right, let's try to talk to the experts and bring in the experts. And they brought in the experts. So to me, that they get a lot of credit, not just for being bearish on housing. I mean, there are all kinds of people who are bearish on housing, but they figured out how to put this trade on, like I mentioned. So I would argue that you need to, in some ways, test yourself, and that's what they did. So they brought in, John Paulson brought in the experts. There was a guy named Josh Rosenberg who traded the ABX index. The ABX index is just like the Dow Jones Industrial Average for subprime mortgages, for these risky mortgages. And he was the Goldman Sachs guy. He was the man. And they brought him in. And that was as they were starting to get bearish, starting to get worried about housing in 2006. And they were starting to buy some of this insurance, some of this credit default swap insurance. And they said, Josh, what do you think about our thesis? And he said, whatever you're selling, I want to buy. In other words, you guys better watch out. And they didn't really know why he was saying that to them. They thought they were maybe this guy Rosenberg from Goldman Sachs was trying to intimidate the guys at Paulson Company. Maybe he was trying to warn them. Maybe he was trying to be a good guy and warn them. They were kind of thrown by it. And they were kind of concerned about their trade when they heard from this guy Rosenberg. And what happened was Pellegrini had put together this great piece of data. And it basically showed how overpriced the housing market was. And he had it on a piece of paper, and they kind of referred to it all the time. They had it on their desks. And they all went into John Paulson's office after this guy Rosenberg challenged their thesis. And they said, boss, you know, Rosenberg's the expert. Maybe we should be thinking twice about what we're doing. And Paulson said, no. He held up that sheet of paper. He said, no, don't forget our data. And they really were confident in their work, and they ignored the experts. And that's what a lot of people didn't do in this world, I would argue. The experts got it wrong, and it's something of a lesson to think twice about those kinds of people. The other thing is, on Wall Street, people make a lot of money, and they often move on and do other things. They retire, find other things to do. So it turns out that most people on Wall Street are relatively young. I mean, I go days and days without talking to anyone who remembers the 1998 when long-term capital, one of the biggest hedge funds, collapsed and the financial system was kind of rocky, let alone anybody who remembered 1992 and those kind of periods when there were pockets of housing weakness. So people on Wall Street just didn't remember that there could be deep issues in the housing market, at least on a national basis. The other issue is that people within organizations, who gets ahead in an organization? Well, it's usually the person who's the optimist, right? It's the person who can say, boss, this is how we're going to beat last quarter's earnings or last year's sales. This is how we're going to take market share from our rivals. And those aren't necessarily the kinds of people who are best suited to anticipate real troubles. They're not paid for those kind of things. They don't think of those ways. And often those kinds of people on Wall Street, they're not in these big organizations. They get shunted aside, and they often go to the hedge fund world. I deal with these guys who run hedge funds, and they're no heroes, but they're interesting, odd characters often. They don't like dealing with customers. They are the people, like Michael Burry, who like to turn off the lights and close their eyes and put their feet up on the desk and think about what could go wrong in this country. And you almost needed that personality to have anticipated these problems. And again, within the big banks, you didn't have too many of those people. There's also an issue of career risk. And frankly, the person who takes, I would argue, the most risk in my entire book is this guy named Greg Littman. Greg Littman was a trader at Deutsche Bank, big, huge bank, and around 2005 or so, 2006, he started getting worried about housing. So he had two choices at that point, right? He could have done what everybody else did on the huge, vast Deutsche Bank trading floor, and that's basically make a wager that housing would stay afloat. Not necessarily it was going to keep climbing, but basically everybody at the bank was putting their money on the fact that there wouldn't be any kind of collapse, any kind of housing meltdown. So he could have done that. And if he had done that, what would have happened? Well, he probably would have kept his job. We have just as many people working on Wall Street today as before the collapse. And what you do is you come up with an excuse. There are all kinds of explanations. I mean, you hear them all day long. Oh, it was a tsunami. It's always like a natural disaster. If I can't figure it out, then it's a national some sort of natural disaster. And that's what they all kind of say. It was a storm. There's all kinds of explanations. And these guys still are paid really well, and they still have their jobs. So he had that choice, that path. Instead, what he did was bet against housing and to buy some of this credit default swap insurance, these CDS contracts. And people at his own bank didn't agree with him. They didn't trust him. They started making fun of him behind his back. They called him Bubble Boy. They teased him. He was like a Cassandra, and people outside the bank were joking about him, and he would have lost his job. Had housing stayed afloat, this guy would have lost his job, and his very well-paid job. And to me, it sort of speaks to why more people didn't do this trade and didn't get worried about housing. So many people got caught up in quarter to quarter. Yeah, I'm concerned down the road, but I'm going to just make this quarter's earnings and sales, and we're going to churn out some of this product and keep selling it to people. And maybe I'm personally concerned about my area, but surely Joe's area is safer than mine. And frankly, in Wall Street, too many firms are in silos, and they don't communicate very well across to each other. Goldman Sachs is one firm that actually does, and they do a much better job of comparing. They can see the risk of Tokyo versus New York versus London, that kind of thing, and it helped them in the downturn. And they got hurt, but not as badly as some other people. And these other firms, lots of times they sort of deferred, and they said, well, I'm going to make my quarter's earnings, and I'm going to keep churning out some of these mortgage-related products, and we're going to keep them on our balance sheet until then, because clearly the housing market is not going to collapse on a national basis, and there's no way that my risk portfolio is shared by the next groups across. The other issue is that there are more Wall Street firms that are public, and you've got these pressures on you as a public company, and you can't really, Chuck Prince, who ran Citigroup, said you got to keep dancing until the music stops. In other words, I'm going to keep playing this housing market and put money in the housing market and have exposure to the housing market, because if I all of a sudden stop, and my competitors are going to take market share from me. And it used to be that on Wall Street there were more partnerships. And you could, and it was the partner's money, and you're risking your own money. And today it's not like that. It's shareholders' money. And people got caught up, and they get paid based on earnings, and they weren't as concerned about the long term. And to me, that's part of the explanation. The other issue is that to me, again, you needed to be somebody who kind of came from the outside. So I'll tell you a little bit of how the trade happened. So basically, they started buying up this insurance. They couldn't figure out why other people weren't doing it. It was dirt cheap. They're buying it left and right. In 2005, 2006, stepping it up. And then it doesn't work for a long time. And their own clients, John Paulson's clients, started getting a little worried. And then finally, in February 2007, it starts working. The housing market, the subprime market starts getting weak. And in one morning, they made $1.5 billion. And again, remember, the biggest trade ever until that point was $1.5 billion for the entire George Soros trade. In one morning, they made $1.5 billion. And their own clients, their clients were happy, obviously, but they were getting a little nervous. They'd never made this much money in a single month before. There was one month where, it was February of 2007, where they told their clients that they made 47% in one of their funds. And one client called up and said, you guys have a typo on your materials. You mean 4.7%. And they were like, no, we made 47%. And more people started calling up John Paulson and saying, you should take some money off the table, cash in some of your chips. And Paulson kept coming back to his sheet of paper, and he said, no, here's the data. We're not going to stray from our view, and we're going to hold on to these positions. And if you think about it, to me, that's another point of pride for them, and it should be, but it was somewhat risky. Had the housing market and the subprime market rebounded a little bit, they would have been known as the guys who were sitting on billions of dollars of profits and gave it all back. And in fact, that's what happened. In the summer of 2007, things started rebounding and improving. And if you remember, the Dow hit an all-time high that summer. And once again, Paulson, instead of getting nervous and selling some of the stuff, he actually bought more. He said, wait a second, if everybody else is really optimistic about housing, and I can see that numbers were there, they're being published, everyone could see that housing was flattening out. So he said, I'm just going to buy more of this stuff. And by the end of the year, he was up $15 billion. And then he expanded his bet to a bet against financial companies in 2008, and they made another $5 billion. So those were sort of the lessons. And I think there's also an issue of having good fortune, too. It's not like it's all, when you do a trade like this, there's a lot of luck or good fortune involved too. He put his trade on, he started betting against housing at just the right time, but he also started learning about housing in his own kind of unique way. There's a guy named Gary Schilling, who's in New Jersey, and he publishes a newsletter. And Gary's about 75 or so, maybe a tad older, and he's been publishing this newsletter forever. And I used to cover the bond market, so I used to get this newsletter. And basically every single issue, I think it's a monthly issue, said the same thing. The world's coming to an end. The world's coming to an end. I would take it, I would read it, I would throw it in the garbage. Right, okay, Gary, the world's coming to an end. Fannie Mae and Freddie Mac, they're worthless. Okay, I get it. And frankly, I think that's what a lot of people did to guys like Gary Schilling. That's a blast from the past there. They ignored him, but lo and behold, the funny thing, and then again I talk about good fortune, John Paulson one day read one of his newsletters because he was just starting to learn about housing and the mortgage and the financial market, and he said, wow, the world's coming to an end, Fannie and Freddie are worthless, I'm going to start betting against those. And he ended up putting this guy Gary on his board of advisors, and he was right and I was wrong, and people like me were wrong. And there's a lesson there too. Sometimes, it's worth listening to the Cassandras. They do sometimes make good points. Maybe they're decades too early or years too early in the case of this guy, Gary. But sometimes there's good fortune too, and he just discovered this kind of information, John Paulson did, at just the right time. So now I'm going to turn a little bit to what I'm seeing out there right now. What are some of the things that people are concerned about? And I'm not going to talk about Europe because that's been written about a lot, and we know a little bit about that. What I try to do is I find quirky, smart guys on Wall Street making interesting trades. And some of these kind of people are really worried about Japan. And Japan is obviously a huge economy, so much more important than countries like Greece and Portugal and different parts of Europe. And the numbers are sort of staggering. So their ratio of debt to GDP is 233%, and it's a non-growing GDP. It's as we all know, and that's up from 120% in 1998. And if you think about it, we're at about 100. Germany's at like 80 or so. They've got an aging population in Japan. they've got all kinds of issues in terms of the yen, and we're starting to finally see it. The yen and JGBs, the Japanese government bonds, are starting to get a little weaker. And the argument has always been, well, yeah, I know Japan's got so much debt, and I know the economy is bad, and I know the population is aging, but 96% of their debt is held domestically, unlike a Greece or even our nation. So they're not going to sell these people, so why should I ever worry? But slowly but surely, there's been a shift, and the largest investor, the biggest pension funds in Japan, the largest investor in Japanese government debt, turned late last year, from a net buyer of government bonds to a net seller of government bonds. And I would argue that slowly but surely interest rates are going to start rising. And the country doesn't need interest rates to be up that much higher for there to be real troubles paying back their own debt. And you can get a real spiraling there, because they can't go on like this, borrowing as much as they do. They borrow about 50% of what they spend. And I would argue that's something that we should all be kind of concerned about and looking at as a potential issue. The other issue is China. So I was there last year, and the growth is amazing, and the educational system in pockets is really impressive. Other parts, not so much. And they're hardworking people, and the shift from the rural areas to the cities is going to help things. And if they can turn into more of a consumer economy, then they'll be okay. But there are real reasons to be concerned. Primarily, or first and foremost, is the fertility rate. And we all know the one-child policy. So the government says the fertility rate is 1.8 per family. You need basically 2.1 to keep population growing, but demographers think it's much lower, and they think the population is going to peak probably 2014, 2015, and it's going to be down a lot by the end of 2020, 2030. So, and just to give you a quick little factoid here, under 14 population was 23% just 5 years ago, and it's expected to be under 17% this year. So you're going to have a massive fall off in labor, and in very cheap labor, over the next 20 years or so. And it's going to be slowly, but I don't want to go crazy over here. But I would argue that we're starting to see the end, or the beginning of the end, of cheap labor. And you can make the same argument about India as well in terms of population. And the sub-Sahara, actually, in Africa, is really the one area where you have a lot of young, growing, big group of young people. But a lot of the reason why China and India have done so well is they've had this massive group of young employers who take lower pay, and it's put pressure on the world. So you could see that kind of shifting, and I don't think it's going to be a dramatic thing. I know some people think China's going to collapse. I think that's the case as well, but I think our competitive advantage as a manufacturer is going to improve. I thought I'd also, and I'll leave some time for Q&A, I'm going to last talk about something I'm really excited about, and that's the new age of energy we're in. And I'm on the East Coast, and when you're on the coasts, you often aren't as focused as one should be, as I should be, on what's happening elsewhere in America. But to me, there have been three booms in my kind of working lifetime. There's obviously there's the tech boom, internet boom, and housing boom, and there's a new energy boom going on. And we're going much closer, we're going to get closer to energy self-sufficiency over the next decade or so, which is just dramatic. I mean, natural gas and oil now coming from different areas called the shale areas, and using fracking and using using horizontal drilling. The extraction and what we're getting out of the ground is just dramatic, and it's going to continue, and it's affecting all kinds of different areas of our economy. Unemployment in places like North Dakota is 3.5%, and other places that just didn't take advantage of the last couple of booms, Western Ohio and New York, and different places in Colorado and some parts of Texas as well, and it's just dramatic there. And also, if you think about what could happen in terms of how it could affect geopolitics, you could argue that we won't have to go to a war, the same kind of places that we've had to. We won't be as dependent on countries that we don't really love, Saudi Arabia, Venezuela, that kind of thing. I mean, there is an argument, Citigroup makes an argument that we're really going to have to just import oil from our friends like Mexico and Canada by the end of this decade. And they're maybe a little optimistic, but we're getting towards that. And there are really 4 guys, actually. I'll just briefly outline who they are, who are responsible for this trend. There's a guy named George Mitchell, who's a 92-year-old guy in Texas, and I went to meet with him recently. He's a fascinating guy, and you can remember stories from the 70s and 80s. He's the son of a Greek goat herder named Savas Paraskovopoulos. I had to write that down so I can remember. And Savas was working on the trains, a railroad guy, back in I think it was the 40s, and they said, Savas, you're never going to make it in this country with that kind of name, that last name. And the guy saying that to him was this guy, Mike Mitchell. So Savas says, well, what's your name? He said, my name's Mike Mitchell. So he said, all right, my name's now going to be Mike Mitchell. So he turned his name into Mike Mitchell, and his son is George Mitchell. And he believed in this shale area, which is just sort of a layer, a rock layer underneath the ground. And everyone over the years said, oh, maybe we can get some oil out of this and gas out of it. And George Mitchell believed, and it finally started working about 2002 or so. And then some other people, there's a guy named Mark Pappas, who's a former Enron guy who believed in horizontal drilling, and they pushed that. There's a guy named Aubrey McClendon, who maybe people have heard about, Chesapeake Energy. Was a fascinating guy. He was more of a landowner. He bought and bought and bought in different regions of this country, and he's largely responsible for the fact that our natural gas bills have tumbled so fast, and he himself has had some problems because of that. He didn't really anticipate that, and he had to be bailed out by his own company in 2008. And then there's a guy named Harold Hamm, who's the John Paulson of this whole trend. He's literally made $12 billion over the past 3 years. And he's not the most famous guy, but he's the 26th richest guy in America. He's richer than all kinds of people, Rupert Murdoch, Sumner Redstone, even the estate of Steve Jobs, and he believed in this area called the Bakken area. And I think you're going to read more about it. It's going to affect us all, and there's all kinds of oil coming from there. And it's not going to keep oil prices lower, but it's going to potentially offset the growth of places like Brazil and some of the emerging markets. And it's going to help in that regard, and it's going to continue to keep our heating bills lower and natural gas prices lower, which will help us all. And eventually, I think we are going to have to invest the money and change our infrastructure in this country so that more cars get their fueling from natural gas, and it'll be a great thing. We need a government that has the backbone to actually spend money on some infrastructure in this country instead of waste it. So I'm going to leave it right there.